All right, everybody. Welcome back. Pickers Market episode 69. Got Tyler, Keith, Lisa, and myself, Kyle. And yeah, I guess it goes quick. We're here.
For sure. Another week goes by.
I know, they do go by quick.
Especially in summer.
Right, especially in summer. Yeah.
Almost over.
Don't be a downer right off the go.
Although I'm over the humidity.
Yeah, it was really bad out there today.
Yeah.
I'll take humidity over.
I know you
10
would.
below.
Yeah. Are you not a winter?
Oh, we're not there yet, Keith.
No.
Please.
Yeah.
Right around the corner.
Yeah.
First, a nice crisp fall is around the
Fall's
corner.
good.
That's
Mhm.
nice.
It's so short.
Crisp air again.
The winter's like 5 months.
Yeah, exactly.
All right. Yeah.
All right, let's get into it. 2 truths and a lie. Hopefully nobody cheated on this one. I made it very straightforward. I went back to the original. Last time I tried the new thing, I did two lies and a truth, and nobody liked that, I guess. So
Too confusing.
Yeah.
too confusing.
Simple
It's too
truth.
early for that. People haven't had enough coffee. And Lisa's got her IV drip, I see this morning. So
Yep. Exactly.
All right,
I'm
so
loaded up.
we'll get it going here. 2 truths and a lie. A, Tesla led the Magnificent Seven in EPS growth this last earnings season. B, BlackRock's chief investment officer describes the current market as the, quote, most bullish investing environment ever. It's a bold statement. C, recession commentary noted during earnings calls is down 84% year on year. Lisa, what do you think?
I think B is correct. At least I've heard others saying that. I don't know if he said that as well, but I give this a true. Tesla, well, I think we have to clarify here because Tesla is technically not in the Magnificent Seven anymore.
They're not. Ooh,
Broadcom, baby.
did they? They're in
Who
there
kicked
now?
him out?
Okay.
You, Lisa?
Of course, I was
Mm.
waiting for that. No. Yeah, Tyler wanted to have Broadcom in there, so we had to do some
I
changes
see.
here.
I see.
Yeah, recession commentary is down. I believe so, but I don't think 84% year over year. We still have the overhang of tariffs, policy changes, if it could drive us into recession or not, which that kind of faded as well, that discussion. But if it's down 84%, that's probably a different percentage here. I go with A is the lie.
Tyler?
Wasn't it Rick Reeder that said that? Is Rick Reeder the chief investment officer?
Mm-hmm. I think
Okay.
so.
Is he? Okay. I'm not 100% certain on his title.
Yeah.
but- okay. So that one's true. Because I did hear him say that. Recession, 84% seems like a stretch, but probably rather than recession commentary, they're noting tariffs and consumer weakness. So I guess that's probably right. So I guess I'll go with A as well.
Yeah. Nice job, by the way. I think these are all bold statements. I mean,
They are. I tried my
yeah,
best.
that was
Yeah.
It's nice. I'm doing the same kind of process elimination. I think, C, 84%. I think that sounds about right because it was so rampant a year ago and don't hear anybody talking about now. So that number works for me. I think B was Rick. I heard that on CNBC as well. So I would process elimination. I'd go, which it's probably not going to be, it's probably true because it doesn't sound like it should be. I'd say A is incorrect. Or
Yeah.
false.
Dream team here. Everybody got it right.
Oh,
Yeah.
yes.
wow.
Tesla did not lead the EPS
Nice.
growth this
Were they
season.
the worst?
No, they were middle of
Okay.
the pack.
Yeah.
They weren't the worst. Yeah. All right.
Good question, though.
Yeah.
Mhm, that was
Yeah.
a good one.
Yeah, the 84% was surprising to me. I was like, oh, is it really
Right,
down
it-
84%
yeah.
year on year? But yeah, like you said, yeah,
It
I
was
mean,
so pervasive
Right.
a year ago. And
right.
now
It
it's-
sounded a lot like 84%, maybe.
Yeah.
If that would be the lie, that's probably a little bit lower than that. But
Right.
yeah, it's actually surprising that it's so high.
All right. Well, the last time I hosted this, we were kind of midway through earnings and we're effectively at the end. We've got a couple retail names left for kind of consumer sentiment, tariff, kind of look through on the consumer this week. But in general, I believe as of this morning, we've got like 95% of the earnings are over. So we've got a pretty good recap on what's happened thus far. And I'm just going to run through a couple of these stats here, and then we can get into it. But these were pretty eye-opening for me. The quarter, this last earnings season, was marked by one of the greatest frequency of earnings beats on record, which when I read that, I was like, I can't even believe that. It just is nuts. It's really, really surprising. The S&P 500 aggregate earnings per share grew by 11% year on year, exceeding the expectation of 4%. So almost tripled the expectation. 58% of companies raised their full year 2025 guide, and that's doubled the share that did so last quarter. So that's really surprising. And then profit margins for the S&P 500 remained more resilient to tariffs than investors feared. So that probably makes sense why we're seeing all those beats. Weaker dollar helped. And then earnings results have continued to be exceptional for the mega cap tech companies. So all in all, pretty good. And this is something we've been talking about behind the scenes, earnings beats don't necessarily mean market rewards. So companies are significantly beating earnings expectations. We just ran through those numbers, but markets are really reacting asymmetrically, rewarding beats and really punishing losers. So just walking through some kind of observations, what do you guys think? There was a chart that I saw just going back the last 20 years, 25 years, the number of companies that are missing, just getting absolutely obliterated. 1 day relative performance moves on average, if you miss, are down almost 10%. A good example would be Target this morning.
Yeah, pre-market. Yeah.
Pre-market, they're down 10.5%. Very unusual for an inline quarter. So what are you guys' take on that? Tyler, I'd be curious to hear, you look at a lot of names. Is this normal? Does it rhyme with anything in history? What are your thoughts?
I mean, I was more surprised on EPS. A lot of the companies beat on EPS, but I was more surprised with how many companies beat on revenues, right? Just the sheer number of companies beating on sales growth, I think was pretty impressive. But as far as the stock reactions, it by far and away not normal. Like if you have a company in your portfolio and they miss, or Target, for example, in line, like it's not a good feeling because you have the stock down 8, 9, 10%. And then if you have a company that beats and even raises guidance for the year, it's like stock's up 50 basis points, 1% that day. It's like, really? But I just think the market is overpriced, right? I think stocks are, and we've been saying this for years, but stocks
overpriced. You mean high valuation?
Yeah, and stocks are priced for perfection right now, regardless of numbers coming down because of tariffs or whatever the case may be. But stocks really are just priced for perfection at this point, and they have to beat and raise to meet that valuation that's on them right now. So it's not a normal environment in that sense.
Do you think that we've sent some charts back and forth over the last couple months? Do you think that the structure is providing some of the additional volatility? Like for instance, 0-day options, that kind of trading it really was any kind of volume, didn't really exist up until COVID. And then I feel like you've had kind of people sitting at home, they're working from home, they've got a little extra time on their hands, can't go to the casino. Let's go ahead and take a look at, the options market.
It certainly could be a factor. But like I sent you guys a chart this morning on credit spreads. Like we're at a point now where we're almost at all-time lows in credit spreads.
Tell people what that means.
So it's the additional yield or premium you get for investing in a corporate bond or a high yield bond over a U.S. Treasury bond, right? So U.S. Treasuries are the safest assets, right? Yep. Because we're never going to default on them. Discussion for a different time. So the spread, the extra income yield that you're going to generate on corporate bonds is almost at an all-time low over that of treasuries.
Which
So
means
so right now you're getting about 79 basis points in extra yield to be in the corporate aggregate index, basically. And high yield, you're only getting 290 basis points of extra yield on top of U.S. treasuries.
so investors
right.
are feeling pretty good about the overall economy. I guess that's the
Ye-
question I want.
Yeah,
Right?
like investors are basically pumping their money into bonds and just squeezing that spread lower because they feel comfortable with balance sheets of even junk bonds, which is pretty incredible to me. I mean, your average spread is like a 500-ish basis point spread in high yield, and you're sitting at 290.
Yeah.
And average spread on corporates is like 105 to 110, and you're sitting at 79. Like you literally are at almost all-time lows. And we're talking about tariff effects and weakening consumers, and bond market and even the stock market for that matter are showing very, very different scenarios. So to your point, or my point, companies are priced for perfection, whether that's equities or the bond side. Like it's just, and maybe the options, maybe all of this extra stuff of trading at home, people watching the news more and becoming more educated on markets and investing since COVID. I would argue that maybe that is part of it, but I think it's a not normal environment right now.
Well, yeah. So retail money flow since COVID has like quadrupled.
Yeah.
Like it's the highest it's ever been. Likewise, options trading of all kinds are higher than they've ever been. So on the credit spreads commentary, because that's a very interesting chart. Do you feel like with equities priced for perfection that there's nowhere left to go, and therefore money is going there as a alternative, but because people like OAS, spreads on credit are harder for people to understand in some cases, and therefore they're just kind of whistling by the graveyard, and we're just going to push money here because stocks are expensive?
Potentially, yeah. I mean, the other aspect of it is when it comes to bond investing, like if you look back statistically speaking, your starting yield is what your return tends to be for the next 10 years, right? So if I'm telling you can get, call it 5.5% on corporate bonds right now, maybe a little bit less, that's going to be your annualized return for the next 10 years based on historical performance of bonds. And so that's a pretty easy thing for retirees to say, I'm good with 5.5% on my $2 million I've got without taking on a lot of risk, right? So I think that's part of it, of people just pumping money onto that side. But as far as nowhere to go, I think there are plenty of places to go. But U.S. equities, U.S. bonds are just priced for perfection. I think international is a good spot to go.
Lisa, what do you think?
Yeah, I think overall it was a good, surprisingly good earnings season, right? I think to bring it back, I think it had a lot to do with last quarter companies suspending their guidance because they didn't know where we are going with policy and tariffs and rates and what to make out of all of that. So Wall Street analysts kind of slashed expectations, and coming in, except for the Mag 7, which expectations are always high, it seems, was pretty low, like you said, around 3.84%. And now that we have a little bit more clarity on what they're going to do with their supply chains and what they're actually planning for, I think they're just better in reporting reporting numbers at all. So I think that was good. When it comes to that companies for missed earnings reports get punished harder, I think we're talking about that for a couple of quarters now. I can remember the last a couple of our earnings season, we were always kind of mentioning, hey, companies that actually beat their earnings get not so much investor excitement than companies that report misses. It just seems it gets more severe and more severe from season to season. And to Tyler's point, I think retail investors have something to do with that. I mean, we saw that in the April sell-off, and we talked about this before.
Mhm.
Well, institutional money sit on the sideline, were pretty bearish. Retail investors jumped in and kind of saved the day a little bit, and were responsible, at least with others responsible of the fast recovery. And I think we see that here as well in the time of, to Tyler's point again, of online education and all the online internet, TikTok, Instagram financial gurus out there, kind of short attention span, and not maybe looking too much into fundamentals, but just wanted to have, make money quick, which also feeds into the options, the rise of the options since COVID. I think especially for younger retail investors, right, that they jumped in with COVID. They never really had a big sell-off. They just had good good memories, I would say, from what they did since COVID.
GameStop all day.
Yeah, exactly. So I think it has something to do with that for sure.
Keith?
Earnings season was good, flat out. I mean, talked about the numbers, grew at 11% versus expectations of 4%. That's a big shift in, obviously I think they were understated because people were worried about tariffs and didn't know what to put in numbers. So that's part of it, but 11% is great. And then I think the full year guidance now, forward guidance, is still right around 10% or slightly above. We started, if you go back up 9 months ago, it was probably around 15. We said it's too high. We said, high single digits, maybe 10. And all of a sudden it dipped, I think got down to like 9. Now it's re-accelerating. So I think that's part of the reason. The thing to worry about, Tyler touched on, is valuations at 22 times. That I think plays into this volatility on the downside. So whether you want to call it price for perfection, there's not a whole lot of room if you come in line or have a little standard deviation of missing. So I think that's an issue. And I think I'm surprised how aggressively they're selling stocks off. I mean, I think we'll talk about a little bit is the fact I think it provides opportunities maybe for portfolio managers. It sucks if you own the name in your portfolio that's down that day, but if you don't, I think there's opportunity that we as portfolio managers say, hey, I think this is more of a one-off. It's very aggressive sell-off. I should be stepping in here and buying things. So I think on the flip, obviously if you own it, it's terrible. If you don't own a stock that's down, there's a couple of industrial names I forget, that were earlier this reporting season. Like, dang, it's like they were in line or slightly weak, and it's like they're down 10, 15, 20%. And that's I mean, what you and I tried to forget the name. It was like a 6 standard deviation move. I'm like, what? That's I mean, that's
like Eaton.
That's the one of them.
Like they beat everything. And I think what did they do? They lowered the high end of their guide, but also increased the low end. So they narrowed it, and because they lowered the high end of the guide, the stock got crushed 5%.
Because the AI link with it now.
I mean, sometimes it's interesting that you really have to dig deep why the stock actually sold off, because some companies actually report, to your point, like solid numbers, and then you really have to dig deep. Okay, what is the issue actually here? Because usually you don't see it, and they sell off of some neglectable commentary maybe sometimes.
Well, I think there's a couple interesting comments. Keith, one of the things that you said, I'd be curious to hear everybody's thoughts, is so when you think about like some of the industrial names that move, or like a Target this morning, valuations, like I do wonder, are they priced for perfection? Because Target's trading at, I don't have the number in front of me, but like 12
times,
12 handle
like
on
the guidance. Yeah, they didn't.
So is that versus Walmart's at 35 times?
Yeah, that's fair.
So you know what I mean? So like, obviously valuation, there's a lot that goes into that, and there's, the cash flows and all the other stuff that feeds those numbers. That being said, I did not do this work, but I'd be curious to see if in this, beats getting healthy reward or moderate reward and misses getting crushed. I do wonder if I broke that out by valuation, quantiles or something like that. Is there actually a rhyme and reason to who's getting punished the most? Because it does seem like, of the Mag 7 names, yeah, there's some punishment that has happened through the tariff tantrum in April and that kind of thing, where they sold off heavily, but they bounced right back, and it was like nothing ever happened, right? So I do wonder if, as growth slows naturally in those, in the AI space over the next couple of years, despite CapEx being nuts, I do wonder if you saw a narrowing like with Eaton of a guide, would it be punished in the same way, even though it is arguably priced for perfection? Or does the investor base with algorithmic trading and retail hype and the kind of animal spirits of AI, do people just ignore and continue? I mean, there's a lot to unbundle there, but
The other thing is when companies are in line and they get punished, if they're not one of these big shiny AI tech names, it's like, why am I owning this when I can just own one of those names that continually goes up? So that's part of the rationale. There's individual trading. I think generally speaking, investors' time horizon is a lot shorter. It's like, okay, just kind of like our attention spans in general
Yeah.
in society, right? Everything's shorter. Give it to me now. I want a quick. I want a pop in the stock. If it doesn't look like it's perfect, I'm out. I'll just move on to
Right.
something else. There's a lot of names that are working, right?
Yeah, I mean,
Market's all-time highs.
I'll
So
play that game, right? You buy the stock right before the close, and then if it depending
now
on-
he's talking his personal account. Let me
depending on-
let's
yeah,
straighten this out here.
Depending on the reaction, right? If it goes down, I'm putting in an order after hours to get out of it before it gets crushed even more, right? So I mean, I play that game, so I'm sure plenty of people.
Now, were you
love
playing
doing
that
that.
game prior to 2020?
Yes,
Okay. Are you playing it more now than you were then?
less now.
Oh, less now.
Yeah.
Okay.
He's getting a little older, a little
Yeah.
wiser.
Well, and he's returned to
Little
office, so
wiser.
he's got less time.
But what was I going to say on that? I kind of got myself off track. I think in a name like Target, though, it's a little bit different, right? Yes, it's cheap compared to its peer group, but Target, I think it's more about the sentiment around it, right? Like how many quarters now in a row have they just
It's been a couple years of struggle.
It's got to be
crap the bed, right?
20
Like,
quarters.
yeah, I mean, so I think that's just more sentiment, and you get your large investor base that's just getting tired of it, and so then you get this mass exodus, and people just price it down and say
United
screw it.
Health's another example, right? It just all of a
Yeah.
sudden, but you get to a point where all of a sudden you have a big investor, Warren Buffett steps in, right? And all of a sudden the stock goes
Yeah.
from 250 to 320 in a week.
Uncle
So
Warren's going to be buying Target.
yeah. Well, I don't know. Maybe
He might.
he never bought healthcare
Wonder
really
if,
before.
wonder if he
so
shops there.
Yeah.
Doesn't he only buy what he uses?
Yeah.
Coke,
Coke.
Buy what
Dairy
you know.
Queen.
That's available at Target. So there's that.
But I think it's on the getting crushed side. I think you're right. It's probably not all priced for perfection. I think there's a mixture of probably low valuation stocks that continually miss, that people just continually sell on the earnings. But then there are companies like an Eaton that's priced at what, 30, 35 times, somewhere in there.
Yep. Forward. Yeah.
And they lower their high end by what, 3 cents or 2 cents, and the stock goes down 5%, right? So
Yeah.
I think if you did that work, I bet it'd vary. But I bet you get a basket of, there's probably nobody like in the middle. I bet it's either very low valuation, like a Target that's trading at 12 times, or high valuation, like in that market plus valuation, so higher than 22 times would be my guess.
Right. All right. Well, we know volatility surging. So this is another, moving on to the kind of related item. Volatility has continued to surge, and there was a chart that I saw that went around a couple weeks ago, but I'm resurrecting it because I think it's so interesting. So unlike previous years, actual stock price swings on earnings are now exceeding expectations for the very first time in history, indicating a possible structural shift in market behavior. So normally spreads between realized moves and implied moves, meaning, if people are expecting the stock to gap down 10% on earnings based off the implied options, usually it's 30-ish% less bad. So it gap down 7 instead of 10. And that's been that way for decades. Now, this last quarter, for the very first time in history, the magnitude of the move is actually more than what was expected. So it's completely inverted. So that 30% discount is now a premium of about 10%. So if you're expecting a move of Target being down 10%, it'll be 11. So sorry for
lovely
hammering our Target so hard today. So, you look at that, and this, I think, ticks and ties with what we've been talking about, and that's some of the changes, whether that be the introduction or reintroduction or growth of retail, algorithmic trading, options, all these different things. But, I guess the other thing would be, and this is probably less for specific companies, but the rise of ETFs and passive obviously flows in there. And I just wonder, are institutional investors, where so many of these money centers, money flows into, are they being outmaneuvered by faster moving retail, quant, X, Y, Z, whatever the insert is for that? Are they being, are we going into a kind of a brave new world where things are upside down and it's now in a different regime than we've ever been in? Lisa, what do you think?
I think overall, with your point with the retail, the rise of the retail and the smart money, like institutionals always like to do, call it dumb money. I think that, and we talked about this in previous episodes, I think that has to change because they have such an influence now. And I think kind of maybe like a little bit more behavioral, a little bit more thinking of behavioral shifts in markets will get more important with more retail investors, how they are thinking about things, and maybe observing social media trends on that. I mean, there is no need to observe that before that or to think of that before that, but it gets more and more important. So I think giving that room and kind of its space and look at this more as how the market is maybe going or headed, I think will be more important or could be more important. And on the other side, which is completely other side of the paper, like options and all of that, that has risk to itself. So is there maybe risk that we do not see yet, that can be maybe a black swan event if something goes wrong there? So yeah, I think it is changing, and we have to maybe adjust a little bit more to that new landscape, or have to adjust a little bit on what signals to look at and what to observe in order to being able to forecast market moves.
Keith?
Yeah, I think it's well said. I think things are changing. It's it's volatility, it's individual retail, it's options, it's ETFs that are, and then all of a sudden there's ETFs that are leveraged, right? There's ETFs that are ETF on one stock, and I think that makes liquidity a lot easier. So I think that makes things go in and out a lot quicker if you want to make those trades. I think that can happen. I still think there's room for everything, and I think there's for a traditional portfolio manager that sits there and does fundamental analysis, I think there's a place for that as well. And I think when there's pullbacks in some of these names, I think that's when that could actually outshine going forward. I think that presents an opportunity to say, okay, let's take a deep look here. And if let's not just look out a month, let's look out 3, 6, 1 year, 2 years. I think there's a lot. I think that's kind of, Warren Buffett's mentality. He's even got a longer time frame, right? He's not talking quarters, he's talking years, I think.
Decades.
And that's decades in some cases, but I mean, you can really make a lot of money, where some of this stuff, whether it's Tyler day trading or whatever he's doing with his PA, is at the end of the day, even so, I trade my own account and stuff like that. And I'm like, I look at it, it's like, the portfolio Steady Eddie one that I manage at work is like doing the same thing that, I have this higher risk bucket in my own account that I do some trading in. And it's like net at the, year to date, I seem like it's like spin your wheels on that. It's like, while you stay the course in these good fundamental names, and it works itself out.
Yeah. Well, on that point, despite the short-term chaos, obviously that creates some long-term value opportunities. So I'd be curious what Tyler's view is, considering he's the day trader in the team now. How do you stay focused on long-term fundamentals and avoid or ignore some of the short-term noise?
I think I think when you're looking to invest over a longer period of time, it's really more about the story of the stock, right? Like if you're going to invest in an AI related company, like what is their story? What is their trajectory? And yeah, there could be some short-term noise where maybe the CapEx cycle slows down and maybe the stock gets killed or whatever it might
Drops
be.
30-40%, right?
Yeah.
Eaten.
And
Yep.
like you know that's going to happen when you're doing that, but you're there for the story, the longer term trajectory of the company. When you're day trading, you have to make those types of reactions. And I would also argue that maybe the traditional fundamentals or traditional valuation metrics are going away, especially with the rise of retail investors, of zero-day options. And the reason I say that, like you look at some of these high-flying stocks, like take Palantir, for example. Darling stock, everybody loves it. Trades at 235 times next year's earnings. But
Or
then
is that
when
revenue?
but then when you put different valuation metrics on it, like Keith and I were talking about the rule of 40, right? Which is revenue growth versus cash flow growth. And you invest in companies that are over 40 and Palantir is still hitting like a 98 or something like that.
Yeah, it's 90. Yep.
Right. So like your traditional PE, like you're not necessarily paying attention as a day trader to like what that valuation metric is because you know that you're just in it for a quick pop, hopefully. Maybe it's the earnings, maybe there's an upcoming catalyst in the next couple of weeks, whatever it might be.
Would you argue it's more immediate or short-term catalyst, whether it be earnings or whatever, or do you think it's actually a technical trade?
Could be technical. I look at it, but I don't use that like as a hard and fast thing that I need to abide by. I would also say it's probably more about momentum as well, or trend, like what you are seeing on TikTok or Instagram or Twitter. Like if you're seeing people talk about it, if you're or go back to the Reddit days, right? Like if you see people talking about it, that's probably a good spot to be for the short term.
For the short term.
Anything else to add, Lisa?
I think Keith and I had the Insight series this week together, and we talked about the optimist case or case for optimism. So whoever's interested in that, go to our website and there's the Insight series. And we sat down for 15 minutes and talked about some things of that. Right, that there's short term, there's a lot of noise. There's a lot going on. Headlines are more negative than positive, right? It's doomsday pretty quick when it comes to financial news and all of that. But what is actually for a long-term investor, what is actually important, right? And what is the things that you miss when you are a default pessimist, just sitting in cash, as opposed to being invested in the market despite all of the sell-offs and everything that's going on up, right, and going on. And then we see, hey, the S&P is mostly up until the right, despite everything that happens over the long term. And I think for every long-term investor, that is something to think back to, and what actually the kind of missed opportunities are if you're not in there. And yeah, staying invested and diversified, that's actually the moral of the whole story, as opposed to being more short-term noise and all of that that's going on.
Yeah, perfectly put, and a great close. So with that, like and subscribe if you like what you're hearing. Thanks, and we'll see you next time.